You're listening to All Things Investing, the podcast that makes money talk simple, smart, and actionable. Whether you're just getting started or leveling up your portfolio, we've got you covered with tips, strategies, and no-fluff advice. Let's grow your wealth, one episode at a time.
So if you took a 25-year-old and a 35-year-old, and they both invested the exact same amount of money for retirement.
Right, the classic comparison.
Yeah. The 35-year-old wouldn't just be like a little behind. They would literally have to work 3 times as hard.
Oh, easily.
And they'd have to invest 3 times as much out-of-pocket cash just to lose by like $200,000 in the end.
It's mathematically brutal, honestly.
It really is. And today we are doing a deep dive into the mathematical cheat code of what we're calling the 30K starting line.
I love this concept.
Yeah, we're sifting through a ton of great sources today, including some really eye-opening data from Hartford funds, some recent 2026 financial reporting from AOL, and this amazing comprehensive blueprint from Wealthy Speak.
Some really heavy-hitting data in there.
For sure. And the mission of this deep dive is to build a hyper-optimized, step-by-step wealth-building machine for you, the listener. And we're centering it entirely around the number 30K.
Right, because 30K is so relatable.
Exactly. Whether that means a starting salary of $30,000 or a monthly income of 30,000 rupees, or even just an annual savings target.
Yeah, it scales perfectly.
It does. It's a universal baseline. It's the unit of measurement we're going to use to architect your financial independence today.
And, you know, starting with that Hartford Funds data about the 25 versus 35 scenario is the perfect anchor for this.
Oh, totally.
Because it really exposes this fundamental flaw in how the human brain processes time and capital. Like, we are biologically wired to understand linear progression, not exponential geometry.
Right. We just don't think in compounding terms naturally.
We don't. When you tell someone they need to start investing at 25, their first instinct is to look at their entry-level paycheck and think, well, the absolute dollar amount I can afford is just too small to matter.
They think 20 bucks isn't going to do anything.
Exactly. They assume that waiting 10 years until they have a much higher salary that it'll allow them to easily catch up. But the math proves that assumption is honestly mathematically fatal.
Yeah, let's actually pull the exact numbers from the Wealthy Speak blueprint, because the disparity is almost physically uncomfortable to look at.
It really is. It hurts a little.
So they modeled 2 investors, right? Person A and person B. Both are assuming an 8% annualized return.
Standard market average.
Yep. So person A starts at age 25, and they put in $5,000 a year for exactly 10 years.
Okay, so by age 35, they've contributed a total of $50,000 out of pocket.
Exactly. And then they stop entirely. They never add another cent of their own capital for the rest of their lives.
Which sounds crazy, right?
It sounds insane. But then you have person B, they wait. They start at age 35, and they also invest $5,000 a year, but they do it continuously for 30 years, all the way to age 65.
So they're putting in $150,000 of their own capital.
Right. 3 times the effort, 3 times the cash drag out of their own life.
Yep.
Yet at age 65, person A, the one who stopped at 35, finishes with roughly $787,000. And person B finishes with only about $566,000.
It's the concept of capital velocity, and the geometric mean.
Explain that a bit, because it feels like magic.
Right. It feels fake. But the money person A, deployed at age 25, had 40 years to run through the compounding cycle.
Which is a massive runway.
Huge. Right. By the time person A is 55 or 60, that original $50,000 isn't what's generating the bulk of the returns anymore. The returns are generating the returns.
It's just feeding on itself.
Exactly. It's like a self-sustaining thermonuclear reaction. The interest from year 1 generated interest in year 2, which generated interest in year 3, and so on.
So by year 30.
By year 30, the capital base has expanded so massively that a simple 8% return on that inflated base just completely dwarfs anything person B can contribute from their monthly salary.
Wow. So person B is just running on a treadmill.
Pretty much. Person B is trying to fight an exponential curve with linear cash injections. It's a mathematical impossibility. You just cannot out-earn a 10-year compounding deficit through sheer labor.
And the AOL reporting we looked at takes this down to an even more granular level for 2026.
Yeah, that stat is wild.
They project that investing just $100 a month at a historical 10% average return starting at age 20 equals over $1 million by age 65.
Just $100.
Just $100. But let's challenge the premise here for a second. Let's play devil's advocate.
Sure, let's do it.
If you're listening right now and you're 22 and you're literally only scraping together maybe 20 or 50 bucks a month.
Right, tight budget.
Mathematically, the friction of like opening a brokerage account and dealing with potential platform fees and managing the tax forms, it makes a $20 monthly contribution practically negligible in the short term, right?
On a pure spreadsheet, yes.
Right. So wouldn't you be better off using that 20 bucks a month to just, I don't know, buy a book on negotiation or get a specialized certification to raise your primary income first, rather than throwing pennies into the S&P 500?
Well, I mean, if human beings operated like rational algorithms, then yes, absolutely.
But we don't.
We don't. We are highly emotional, behavioral creatures, and behavioral architecture is far more important than initial capital allocation.
What do you mean by behavioral architecture?
So the primary function of investing $20 a month at age 22 is not the yield on the $20. You're not trying to get rich off that specific $20 bill.
Okay.
The primary function is neurological conditioning. You are building the automated plumbing of a wealth system.
Oh, I see. You're building the habit.
Exactly. If you wait until you have a quote-unquote respectable amount of capital, say like $1,000 a month, to finally open the brokerage account and set up the automated routing, you're in trouble.
Because you're relying on your future self to do the hard work.
Yes. You are relying on future willpower to initiate a really complex behavior. But by setting up the routing when the stakes are just $20, you establish a physiological habit of paying your future self first.
The pipes are already laid.
Precisely. The infrastructure is built, it's tested, and it's running quietly in the background. So when you finally get that $20,000 raise, you don't have to learn how to invest from scratch.
You just turn the dial up on the water pressure.
You just turn the dial. The water flows through the pipes you built years ago. It's frictionless.
That makes total sense. So, okay, we've established that time in the market solves the growth problem.
Yep. Time is your best friend.
But, growth is utterly irrelevant if your capital is leaking before it ever even reaches the compounding engine.
Oh, the leaks. This is where most people lose the game.
Right. And the sources dedicate a massive amount of real estate to this psychological trap that just steals young people's capital. They call it lifestyle inflation.
The ultimate wealth killer.
It is. But looking at the mechanics, lifestyle inflation isn't just like a treadmill you get stuck on. It's almost like a physiological dependency.
That's a great way to look at it.
The sources liken it to nitrogen narcosis for scuba divers.
Oh, that analogy is spot on.
Right. The deeper you go into your career and the more money you make, the more intoxicated you get by the pressure and the status.
You start buying the nice watches, the better clothes.
Exactly. And you stop realizing that your oxygen, which is your actual disposable investable income, is just running out.
Nitrogen narcosis is an incredibly accurate way to frame it because it really highlights the insidious nature of the phenomenon. It sneaks up on you.
Totally sneaks up on you.
It's hedonic adaptation. It ensures that whatever luxury you buy rapidly degrades into just a baseline necessity in your mind.
Right. Yesterday's luxury is today's bare minimum.
Let's look at the baseline wealthy speak example from the sources. An individual receives a salary bump from $60,000 to $75,000.
A nice $15K bump.
Great raise. That $15,000 delta represents pure, unallocated capital. It's free money they didn't have yesterday.
Right.
But now, society and specifically consumer marketing conditions that individual to view that $15,000 as a mandate to upgrade their baseline existence.
Like, I earned this, I deserve a treat.
Exactly. So they finance a newer vehicle, they move to a slightly bigger apartment with high-end amenities, they upgrade their wardrobe.
And suddenly,
their fixed operating costs expand to perfectly consume that $15,000. Their net liquid wealth remains exactly zero.
they didn't actually get any richer.
Not a single penny richer.
And the structural danger there isn't like buying an expensive coffee or having a nice dinner to celebrate the raise.
Yeah, dinners are fine.
The danger is locking in fixed liabilities. When you finance a $50,000 car, you aren't just losing 50 grand. You're locking in a rigid, non-negotiable monthly cash drain.
A drain that happens every single month, whether you lose your job or not.
Right. The sources point out that the average new car payment is hovering around $700 a month right now.
Which is just staggering.
It's insane. And if we run that through the compounding engine we were just talking about, a $700 monthly payment invested at a standard market return over a 40-year working life turns into roughly $2.2 million.
2.2
million. So the mechanical reality is that you are not buying a $50,000 car. You are permanently destroying $2 million of future purchasing power.
And you're doing it in exchange for an asset that is statistically guaranteed to depreciate in value every single day you own it.
It's literally rusting in your driveway while it burns your millions.
Exactly. You are trading future capital velocity for immediate depreciating status.
So how do we fight this? What's the counter strategy here?
The counter strategy the sources advocate is the adjusted 50-30-20 cash flow model.
Okay, break that down, because I know the traditional 50-30-20 rule is a bit different.
Right. The standard model historically taught 50% for needs, 30% for wants, and 20% for savings.
Which sounds reasonable.
It's okay. But the adjusted wealth building blueprint flips the leverage. It maintains 50% for hard needs, so your rent, utilities, groceries, but it restricts discretionary wants to 20%.
Slashing the wants.
Slashing them.
Right.
And it mandates a massive 30% allocation to the investment engine.
20% is a huge chunk of your income to invest.
It is huge. And the only way to mechanically achieve a 30% investment rate early in a career is to ruthlessly suppress those fixed cost lifestyle upgrades when your income rises.
You have to quarantine the raises.
You quarantine the raises. If you get a raise, your lifestyle stays exactly the same, and 100% of the new money goes into the investment bucket.
Okay, but let's break down the mechanics of quarantining a raise, because I can hear the listeners pushing back on this.
I'm sure they are.
If we're telling you to maintain a flat lifestyle cost while your income doubles over a decade, the natural friction point is burnout, right?
Oh, absolutely. Burnout is a huge risk.
Like, if the whole point of increasing your market value and working hard is just to hoard capital in a brokerage account until you're 65, that sounds like a miserable way to spend your 20s and 30s.
It sounds awful, just eating plain rice and living with 5 roommates.
Right. So there has to be a pressure release valve in this 20% wants category, right?
Mm.
How do you mathematically justify aggressive spending in the present without sabotaging your compounding curve?
Quick break. If you're enjoying all things investing, be sure to follow, rate, and share this episode with a friend who needs to start investing smarter. Got questions? We might answer them in the next episode. Now, back to the show.
It really comes down to distinguishing between fixed structural liabilities and variable joy-based spending.
Okay, explain the difference.
The financial educator Ramit Sethi frequently talks about this concept of a rich life, and the math actually supports spending extravagantly on the few variable things that actually drive your dopamine baseline upwards.
So spending on things you actually love.
Yes, whether that's international travel or high-end fitness coaching or collecting rare books, whatever it is.
But those are variable costs.
Exactly. You can easily fund a $5,000 annual travel budget if you are driving a fully depreciated 10-year-old Honda Civic and living with a roommate.
Because the Civic doesn't cost you $700 a month.
Right. The structural trap is the $2,500 luxury apartment lease and the $700 car payment. Those are fixed liabilities.
They just bleed you dry every month.
They drain your cash flow regardless of whether you are actively enjoying them or not. If you keep your fixed structural costs ruthlessly low, well under that 50% threshold, you generate massive amounts of free cash flow.
And then you have options.
Exactly. You can then direct that cash flow simultaneously into aggressive 30% investing and highly targeted, guilt-free 20% variable spending on stuff you actually love.
Okay, so we have the behavioral framework dialed in. We are quarantining our raises, we're avoiding fixed liabilities, and we're generating all this surplus capital.
We have the cash.
Now we have to actually route that capital. The sources outline a very rigid, sequential architecture for deploying it, which we can call the priority ladder.
The priority ladder, it's a great visual.
And this isn't just arbitrary, right? Each rung of this ladder is mathematically designed to protect the subsequent rungs from systemic failure.
Yeah, it operates as a defensive perimeter. If you skip a step, the entire architecture becomes fragile.
Like building a house on sand.
Exactly. You cannot build a compounding equity engine if you have glaring structural vulnerabilities in your liquidity or your debt profile.
So let's climb the ladder. Step 1 is the emergency fund.
The foundation.
The directive is 3 to 6 months of baseline living expenses sitting in a high-yield savings account. Let's map this to our 30K unit of measurement.
Let's do it.
If your monthly operating expenses are 15,000 rupees or $1,500, you are targeting a highly liquid cash cushion of 45,000 to 90,000 rupees or $4,500 to $9,000.
You're right. 3 to 6 times your baseline.
And the sources note that as of 2026, these high-yield accounts are returning roughly 4 to 5%.
Which is pretty decent for cash.
But, okay, from a pure optimization standpoint, Holding 3 to 6 months of cash when inflation is constantly eroding purchasing power? It feels a little inefficient, doesn't
I
it?
hear this argument all the time from young investors.
Like, why trap that capital in a 5% yield when the broader market historically returns 10%? Aren't we intentionally dragging down our aggregate portfolio return by holding so much cash?
You are, but you are intentionally dragging down the return to eliminate sequence of returns risk and forced liquidation.
Source liquidation, okay.
Listen, an emergency fund is not an investment. People need to stop looking at it like one. It is an insurance policy with a nominal yield.
That's a huge mindset shift.
Let's look at the mechanics of a market drawdown. Economic recessions are highly correlated events.
Everything goes down at once.
Right. When the equity markets contract by 30%, corporate earnings compress, which triggers mass layoffs.
So you lose your job right when your portfolio tanks.
Exactly. If you do not have a liquid cash buffer, the exact moment you lose your primary income stream is statistically highly likely to be the exact moment your portfolio is at its lowest valuation.
That's a nightmare scenario.
And then life happens. If your car transmission fails or your roof leaks during that macroeconomic trough, and all your capital is fully deployed in equities, you are forced to sell those equities at a 30% loss just to generate cash to fix your car.
Wow. So you're crystallizing the loss.
You lock it in.
You are permanently removing those shares from your portfolio, meaning they aren't there to capture the upside when the market inevitably recovers.
Precisely. You have permanently impaired your compounding curve. The opportunity cost of holding cash at a 5% yield is just the premium you pay to ensure you never have to liquidate your equity engine during a crisis.
It buys you time.
It provides the psychological and financial duration required to just sit on your hands and let your volatile assets recover.
Okay, I love that. So once that liquidity fortress is built and fully funded, we move to step 2 on the priority ladder, the employer match.
Free money?
Literally. If your company offers a 401k or a localized equivalent, and they match a percentage of your contributions, the directive from the sources is to fund that account exactly up to the match limit before doing anything else.
It is an arbitrage opportunity that cannot be replicated anywhere else in finance. You just can't find it.
Give me an example of how powerful this is.
Okay, if your employer matches 100% of your contributions up to 5% of your salary, deploying that capital generates an immediate, risk-free 100% return on investment. Instantaneous. If you put in $5,000, it instantaneously becomes $10,000. There is no hedge fund, no algorithmic trading model, and no alternative asset class that guarantees a 100% instantaneous return.
Doesn't exist.
It doesn't. Skipping the match is mathematically equivalent to taking a voluntary pay cut.
Why do companies even do this?
Well, the structural reason corporations offer this is tied to tax incentives and talent retention. But from the employee's perspective, none of that matters. It is just pure, frictionless capital acquisition.
So, get the match. That brings us to step 3, which is the vascular system of capital. High-interest debt.
We have to stop the bleeding.
The blueprint defines this as anything carrying an interest rate above 7%. So we're talking credit cards, high-yield personal loans, maybe some really bad auto loans.
The toxic stuff.
We're basically talking about reverse compounding here, right?
Yeah.
If you hold a credit card balance at a 24% annual percentage rate, the mathematics of the geometric mean are working against you with the exact same ferocity that we want them working for you in the markets.
It's terrifying when you look at the math of a 24% APR. Debt avalanche mechanics dictate that you must neutralize these high-interest liabilities before allocating a single dollar to discretionary investments.
You can't out-invest a 24% credit card.
You really can't. Consider the cost of capital. If you carry a balance at 24% and you simultaneously invest capital in an index fund hoping for a 10% return, you are mathematically locking in a negative 14% arbitrage spread.
We're losing 14% every year just by trying to do both at once.
Exactly. Every dollar you deploy to pay down that 24% credit card is mathematically identical to finding a risk-free investment that yields a guaranteed, tax-free 24% return.
And you will never find a positive yield that outpaces unsecured consumer debt in the stock market.
Never. You must plug the structural leaks in the hull before you attempt to accelerate the ship.
All right, hull is plugged. This brings us to step 4. And this is where we really have to look deeply at the architecture of the tax code. We are talking about the Roth IRA.
The holy grail for young investors.
In 2026, the contribution limit sits at $7,500. Now, to understand why the Roth is the ultimate vehicle for our 30K starting line, we have to look at how tax brackets actually function over a human life cycle.
Right, because the government isn't just handing out free money out of benevolence.
Definitely not. What is the macroeconomic mechanism behind this Roth structure?
To really understand the Roth, you have to look at its legislative history. It was established by the Taxpayer Relief Act of 1997, named after Senator William Roth.
Okay.
And the structural innovation here was reversing the timeline of tax liability.
How so?
With a traditional pre-tax retirement account, the government gives you a tax deduction today, but they tax both your original contributions and all the compounded growth when you withdraw it in retirement.
So they're basically taking a deferred equity stake in your entire portfolio.
That's exactly what it is. Senator Roth's legislation created a vehicle where you pay the taxes up front on the seed money, but the government forfeits their right to tax the harvest.
Wow, it's a marginal tax rate arbitrage.
Yes, and it's brilliant.
Because if you are 25 years old and making a starting salary, your marginal income tax bracket is likely the lowest it will ever be in your entire working life.
You're barely paying any taxes, relatively speaking.
Right. You might be paying 12% or 22% on those last dollars of income. So you gladly pay that highly discounted tax rate today, lock the capital inside the Roth architecture, and then over 40 years, that $7,500 compounds into a massive sum.
A truly massive sum.
And when you withdraw it at age 65, when you might be in a vastly higher effective tax bracket due to all your accumulated wealth, the tax liability is absolute zero.
0%. It provides unparalleled tax diversification in retirement.
It's amazing.
But, the real structural brilliance for young investors is the liquidity feature.
Oh, right. Because people worry about locking their money away until they're 60.
Exactly. Unlike traditional retirement accounts that lock your money behind severe early withdrawal penalties, the IRS allows you to withdraw your contributions from a Roth IRA at any time, for any reason, without penalty or taxes.
Just the contributions, though, right?
Yeah.
Not the earnings.
Correct. Just the principal you put in. Because you already paid taxes on that money.
So it actually functions as a secondary, highly aggressive tier of your emergency fund.
It does. It beautifully balances the defensive need for potential liquidity with the absolute most powerful offensive tax advantage in the federal code.
So maxing out that $7,500 limit is non-negotiable for optimized wealth architecture.
Non-negotiable.
Okay, so the infrastructure is fully operational. We have the liquid cash buffer. We captured the corporate match arbitrage. We eliminated the reverse compounding debt. And we built the tax-free Roth fortress.
We've got all the buckets lined up.
But the accounts themselves are just empty wrappers, right?
Yeah.
They're the plumbing. We haven't talked about the water.
The actual assets.
What actual assets are we routing into these tax-advantaged accounts to generate those historical 10% returns we keep talking about?
Right.
The sources are unanimous on this, and honestly, the mechanism for wealth generation is devastatingly boring. It's broad market index funds.
It is so boring, and that's why it works. The financial entertainment complex spends billions of dollars every year trying to convince retail investors that wealth generation requires active stock picking.
Or complex options trading.
Or timing macroeconomic cycles, or getting in on the latest crypto craze. And they do this because complexity justifies high management fees and generates trading volume.
They need you to trade so they can make money.
Exactly. But the empirical data, which is corroborated by decades of academic research and all the sources we are analyzing today, proves that the optimal strategy is passive, broad market indexation.
Let's break down the mechanics of an index fund, specifically something like the S&P 500, because it isn't just a static list of 500 companies, is it?
No, it's very dynamic.
It is an algorithmic self-cleansing system. When you buy a broad market index fund, you aren't trying to find the needle in the haystack. You are buying the entire haystack.
I love that quote. John Bogle.
Yeah.
Right.
Yep. But how exactly does the internal machinery of, market cap weighting ensure that the investor automatically captures the upside of the market while mitigating idiosyncratic risk?
That is the crucial distinction to make. A market capitalization-weighted index fund automatically adjusts the percentage of each company it holds based on that company's total market value.
Okay.
So let's say you own an S&P 500 index fund. As a company succeeds, grows its earnings, and its stock price rises, its market cap expands.
Right.
The index fund's algorithm automatically increases your exposure to that winning company. You don't have to do anything.
It just buys more of the winners.
Exactly. And conversely, if a company is fundamentally flawed, loses market share, and its stock price collapses, its market cap shrinks, the index automatically reduces your exposure to that dying company.
And eventually, Exactly, if it drops out of the top 500.
The index unceremoniously dumps it and replaces it with a growing competitor.
It's literally financial Darwinism. It's a ruthless, automated system where dying companies are starved of your capital and thriving companies are fed.
It's a beautiful machine.
But let me push back on this from the perspective of a younger investor who's watching these massive technological shifts right now.
Sure.
We look at the sheer dominance of artificial intelligence, machine learning, the mega-cap tech stocks.
The NVIDIAs of the world.
Right. If you believe that a specific sector is going to completely redefine the global economy, doesn't burying your capital in a broad market index fund virtually guarantee you miss out on the astronomical gains of the next defining tech monopoly?
It guarantees the exact opposite, actually.
Wait, really?
Yes. That pushback fundamentally misunderstands the momentum mechanics inherent in a market cap-weighted index. You do not miss out on the next massive tech monopoly because the index fund will forcefully acquire it for you as it grows.
Oh, I see.
If a small AI-driven startup today begins to dominate its sector, its valuation is going to increase.
Yeah.
As it enters the S&P 500, your index fund buys it.
Automatically.
Automatically.
Yeah.
And as it scales to become a trillion-dollar behemoth, the index fund continues allocating more and more of your capital toward it.
So you captured the massive upside without having to take on the concentrated risk of guessing which specific AI startup will win the war.
Exactly. Because for every one company that becomes a monopoly, 99 go bankrupt. The index fund eliminates the risk of picking the bankruptcies while guaranteeing exposure to the eventual winner.
That is so powerful, and it does this while stripping out the massive cost drag of active management.
The fees are where they really get you.
The sources note that a broad market index fund operates with expense ratios as low as 0.03%.
Practically free.
Practically free.
Huh.
But if you use an active fund manager who charges, say, a 1% or 1.5% fee, I mean, that sounds negligible to most people. What's 1%?
It sounds tiny.
But over a 30-year compounding horizon, that 1% fee doesn't just eat 1% of your returns, does it?
Oh, no. It consumes upwards of 25% to 30% of your total ending wealth.
30%.
Because you lose the compounding effect on all the capital that was siphoned away as fees over those 3 decades.
It's the arithmetic of active management, which was famously outlined by William Sharpe, right?
Yep. Sharpe's arithmetic. Before costs, the return on the average actively managed dollar will equal the return on the average passively managed dollar.
Because they make up the entire market.
Right. But after costs, the passive dollar must mathematically outperform the active dollar. It's a mathematical certainty.
And the AOL reporting specifically highlights the behavioral danger of overtrading, too.
Oh, yeah. Retail investors love to trade.
Buying and selling individual equities, trying to time earnings calls or macroeconomic news, the bid-ask spreads, the short-term capital gains taxes, the friction costs, they inevitably just destroy their net returns.
True wealth architecture relies on absolute automation. You set the systematic routing of your capital into the index fund, and you remove human emotion from the equation entirely.
Let's pivot slightly to the alternative asset class mentioned in the Wealthy Speak framework. Once the index fund engine is humming, they discuss scaling into real estate to capture both yield and leverage.
Real estate is fascinating.
But they bifurcate the strategy into 2 entirely different operational models: house hacking versus REITs. And the mechanical differences here regarding leverage, liquidity, and human capital are massive.
They are completely different games. Real estate is a highly inefficient market, which makes it an excellent vehicle for wealth generation if you understand how to utilize leverage.
So explain house hacking first.
House hacking is essentially an arbitrage on primary residence mortgage rates. When you buy a pure investment property, banks typically require a 20% to 25% down payment, and they charge higher commercial interest rates.
This is riskier for them.
Exactly. But if you buy a multifamily property like a duplex or a fourplex, and you physically live in one of the units, the bank classifies it as a primary residence.
Which changes everything.
It changes all the math. This allows you to use government-backed loan programs to acquire the asset with as little as 3.5% or 5% down.
You are utilizing extreme leverage. You're controlling a massive appreciating asset with a very small amount of your own capital.
And the mechanical beauty of house hacking is that the tenants in the other units are paying the mortgage for you.
They are amortizing the debt while you capture the geographic appreciation of the underlying asset.
It's an incredible wealth builder. But there is a catch.
The trade-off is your human capital.
Right. Big time. You are taking on severe operational risk. You are a property manager now.
You are dealing with vacancy rates, broken plumbing at 2 a.m., and potentially eviction proceedings. It is highly illiquid and highly operationally intensive.
Which is precisely why the blueprint offers the secondary path, real estate investment trusts, or REITs.
I love REITs.
They're great. A REIT is a corporate entity that owns, operates, or finances income-producing real estate. It could be commercial office space, residential apartment complexes, or even specialized assets like data centers or cell towers.
And the tax structure is unique.
Yes. By law, a REIT must distribute at least 90% of its taxable income to shareholders annually in the form of dividends.
So it provides the exact inverse profile of house hacking. You buy shares of a REIT on a public exchange, exactly like you buy an index fund.
You get instant liquidity.
Instant liquidity. You capture the cash flow of the underlying real estate through the mandatory dividend distributions. You get exposure to an asset class that has a lower correlation to equities, providing diversification.
And your operational requirement is absolute zero.
You never have to unclog a drain or chase down a late rent check.
But you sacrifice the extreme leverage and the primary residence tax advantages of house hacking.
Exactly. It comes down to a fundamental choice of how you want to deploy your finite human capital.
If you have the operational bandwidth and the desire to manage physical assets, house hacking accelerates the compounding curve through leverage.
But if your human capital is better deployed, advancing your primary career or starting a business, REITs provide the necessary asset diversification without the operational drag.
That's the trade-off.
Okay, so we have all the theoretical components on the table.
Yeah.
We understand the tax wrappers, the equity engines, the real estate diversifiers. Now we have to execute.
Let's put it all together.
We are going to build the concrete, highly specific asset allocation model derived directly from the sources.
The 30K blueprint.
Yes. If a listener has exactly 30K to allocate every single month, and again, we are using the units from the sources, whether that's 30,000 rupees in the Indian context or a scaled dollar amount, how exactly does the capital flow through this plumbing?
The synthesis of all these sources results in the 70255 allocation blueprint.
70255.
Yes. This is designed for an investor in their wealth accumulation phase, possessing a multi-decade time horizon.
So younger investor.
Right. It optimizes for maximum geometric growth while introducing just enough structural ballast to prevent behavioral panic during market contraction.
That's throughout the first tranche, 70%. That is 21,000 units out of the 30K. This is the aggressive growth engine, right?
Yes. The 21,000 units flow directly into broad market equity index funds. This represents your ownership stake in the global economy,
Which we established is the best place to be.
over a 30-year horizon. Equities are the undisputed supreme wealth-generating asset class. They capture human innovation, corporate efficiency, and inflation.
But they are volatile.
Highly volatile. You will experience years where this 70% tranche loses 20% or 30% of its nominal value.
Which is terrifying.
It is, but because your time horizon is measured in decades, that volatility is mathematically irrelevant to your terminal wealth.
But the volatility is relevant to human psychology, which brings us to the second tranche, 25%.
It's a ballast.
But it's 7,500 units out of the 30K. The blueprint allocates this to fixed income or debt funds, high-quality corporate bonds, sovereign debt, short-duration treasuries.
Safe stuff.
Now, the modern consensus among a lot of hyper-aggressive young investors online is that bonds are dead.
Oh, I hear it all the time. Bonds are trash.
Right. Why accept a 4% or 5% yield on 25% of your portfolio when you have 30 years to ride out the equity volatility? Isn't the 25% debt allocation just creating a massive cash drag on the total portfolio CAGR, the compound annual growth rate?
Well, again, if the investor were an emotionless algorithm, yes, a 100% equity portfolio would likely yield the highest terminal value.
But we aren't robots.
We aren't robots. The 25% fixed income allocation is not there to generate alpha. It is there to manipulate the standard deviation of the portfolio.
Okay, what does that mean in plain English?
It is structural ballast.
Yeah.
When the equity markets suffer a severe macroeconomic shock, central banks typically lower interest rates to stimulate the economy.
They cut rates.
And because bond prices move inversely to interest rates, the value of your fixed income allocation often rises exactly when your equities are collapsing.
Oh, so it provides non-correlated buoyancy.
Exactly. It smooths the volatility curve. By reducing the depth of the portfolio's drawdowns, you significantly reduce the psychological pressure that causes retail investors to panic and sell at the absolute bottom.
So it stopped you from doing something stupid.
Basically, yes. And furthermore, it provides the dry powder necessary for the rebalancing premium, which is the secret sauce we will discuss in a second.
Okay, let's throw out the final tranche first, 5%. That is 1,500 units out of the 30K. The diversifier.
Right. This final sliver is allocated to alternative, non-correlated assets. It's to protect against structural systemic risks that equities and domestic bonds might both fail to hedge.
Like what?
Well, this could be physical gold ETFs to hedge against extreme fiat debasement. It could be international emerging market equities, or it could be those REITs we discussed earlier.
It's an insurance policy.
It ensures that a localized economic collapse in one specific sector or region cannot mortally wound the entirety of your net worth.
Okay, let's examine that rebalancing premium you mentioned, because this is where the 70255 split moves from a static allocation to a dynamic wealth generator.
This is where the magic happens.
The directive is to automate these transfers via a systematic investment plan. Assess P the day after payday. Total automation. But once a year, you must manually intervene to rebalance. Let's look at the mechanics of this.
Okay, let's play out a scenario.
Let's say the equity markets have an incredible bull run. Your 70% index fund allocation might swell to represent 85% of your total portfolio value.
Which means your 25% debt allocation has shrunk to 10%, and your 5% alternative is down to 5%, relatively speaking.
Right. Human instinct tells you to let the winners run. Keep the 85% in stocks. But institutional wealth management dictates that you must enforce the original mathematical ratios.
You have to. You log into your brokerage once a year, and you deliberately sell off the excess equity outperformance, bringing it back down from 85% to 70%.
Taking profits.
Yes. You take those profits, and you use them to purchase more of the underperforming debt and alternative assets, bringing them back up to 25% and 5%.
You are mechanically forcing yourself to do the hardest thing in finance.
Yeah.
You are systematically selling high and buying low.
It is brilliant because it strips the emotion out of profit-taking.
You are locking in the equity gains and using them to buy the temporarily depressed assets at a massive discount.
It's an algorithmic rebalancing bonus that mathematically enhances the risk-adjusted return of the entire portfolio over decades.
It's just so elegant.
That is the architecture of wealth. It limits catastrophic risk through diversification, it ensures exponential growth through the equity engine, and it guarantees disciplined execution through automation and systemic rebalancing.
Over a 30-year horizon, this highly structured, seemingly boring 30K split realistically mutates into multi-million-dollar generational wealth.
Without a doubt.
The clarity of this framework is incredible. It really strips away the anxiety of modern finance. We've mapped out the entire mechanical journey today.
We covered a ton of ground.
We started by proving the sheer mathematical violence of the 10-year compounding gap between starting at 25 versus 35.
The Hartford Fund stat.
Yep. Then we dissected the physiological trap of lifestyle inflation, proving that quarantining your raises and avoiding fixed liabilities is the ultimate lever for free cash flow.
Watch out for the $700 car payment.
Seriously. Then we built the priority ladder, locking in the liquidity of the emergency fund, capturing the arbitrage of the employer match, neutralizing reverse compounding debt, and maximizing the tax-free architecture of the Roth IRA.
The defensive perimeter.
Exactly. We dismantled the illusion of active stock picking in favor of the self-cleansing algorithms of broad market index funds. And finally, we engineered the automated 70255 blueprint.
The critical takeaway for the listener here is really a shift in identity.
How do you mean?
Wealth is not some opaque lottery system reserved for individuals with trust funds or insider information. It is a predictable mechanical output derived from 3 highly accessible inputs: time, discipline, and automation.
Anyone can do it?
The specific dollar amount you start with is largely irrelevant compared to the structural integrity of the system you build to process it.
It's about the habit.
The capital allocation decisions you automate today are, quite literally, purchasing future autonomy. You are acquiring the ultimate luxury asset, which is sovereign control over your own time.
You are buying your own freedom.
Yeah.
I love that. Now, as we wrap up this deep dive, I want to leave you, the listener, with a final, slightly provocative thought drawn from the margins of the Wealthy Speak framework.
Oh, this is a good one.
We have spent the last hour meticulously detailing the mechanics of deploying your capital into financial markets, into equities, sovereign debt, and real estate.
The traditional assets.
Right, and we have optimized for a 10% historical return. But the sources briefly touch on an entirely different asset class: human capital.
Yourself.
They note that direct investment in your own earning capacity yields an infinite, unquantifiable ROI.
It is the apex leverage point. Think about it. If you deploy $1,000 into an S&P 500 index fund, you might realistically generate $100 in growth over 12 months.
Which is great.
It's great. But if you deploy that exact same $1,000 into a specialized coding boot camp or advanced sales training or a high-level industry certification, that acquired skill could easily yield a $10,000 increase in your baseline salary.
That is a 1,000% return on invested capital in year one.
And it compounds.
Yes, because that new elevated baseline salary becomes the new input for your 70255 compounding engine. So the secondary effects of that initial human capital investment ripple through the entire multi-decade architecture we just built today.
It supercharges the whole machine.
It really does. So as you audit your cash flow and prepare to deploy your 30K framework, ask yourself a structural question. If you are fundamentally the most valuable, highest yielding asset in your entire portfolio, exactly what percentage of your capital is currently being routed toward upgrading your own operating system?
A very necessary question to ask.
Something to think about. Until next time, keep building.
Thanks for tuning in to All Things Investing. Don't forget to subscribe so you never miss a tip that could boost your financial future. Follow us on TikTok, YouTube, and wherever you get your money advice. Until next time, keep investing in yourself. Financial disclaimer. The information provided on the All Things Investing podcast is for educational and informational purposes only. It is not intended as financial, investment, tax, or legal advice. Always do your own research and consult with a licensed financial advisor or other qualified professional before making any investment decisions. The views and opinions expressed are those of the host and guests, and do not constitute official recommendations. Investing involves risk, including the potential loss of principal. Past performance is not indicative of future results. By listening to this podcast, you agree that the host and associated parties are not responsible for any financial decisions you make based on the content provided.